Hey everybody, this is Mark Smith, the host of Digital Roughneck, and I'm here with Ryan Keys, the CEO of Triple Cone. Welcome, Ryan.
Oh, thank you. And technically, it's president. My partner Nathan Picard and I co-founded the business 4 years ago. So
All right. Well, listen, today's topic is ESG, and how would you describe, Triple Crown? I mean, like, where are you at, kind of number of wells, so that people get an idea of, like, are you super major? Are you like, where are you at size wise and stuff like that?
we are at about 130 horizontal wells, and these are the modern horizontal wells that drilled and completed in the Wolfcamp Formation. And we're actually a little bit unusual. Most of the folks in the Permian Basin have a lot of legacy old vertical wells. We don't. We only have two. So it's a little bit easier to manage fewer wells. So that's something we're actually pretty grateful for. And those 130 wells thereabouts are producing gross, which includes the share that goes to our royalty owners, about 16 to 17,000 barrels of oil equivalent per day.
Okay, great. So how has the whole ESG thing impacted your energy company?
On a very fundamental, foundational level, absolutely. The big publics were those to really embrace and acknowledge, because they have the largest, most diverse group of investors. It's the general public, it's institutional money. So the large independents, for example, Pioneer, and Diamondback, two of our neighbors, and then the majors, Exxon and Chevron and Shell. They had to embrace this, quite a bit before the rest of the industry, because of that very diverse investor base. And these investors get to vote with their pocketbooks, and also they get quite literal voting rights. And you saw this, engine number one activist investor movement last year, where it's a bit controversial, but there is a lot of momentum behind it. And they did have to embrace the will of at least a subset of their investors. For Triple Crown, we're our size. If we were public, we're private. We're not publicly traded. But if we were on the stock market, we would be on the very low end of those in terms of size of the public companies. Probably bottom quartile, bottom decile of those publics. But we looked at it, instead of the oil and gas industry. There's a lot of different reactions. So, a lot of them, especially on the smaller independent side, the reaction was very negative. Like, what is this? What are we being forced to do? There's traditionally, over its 150-year history, been a lot of knee-jerk reaction in the oil and gas industry, and this time was no exception. But looking at it objectively, we can really get behind some of this stuff as a producer. It's in the long-term best interest of our industry to get good at a lot of this, and one of them is very near and dear to your heart and mine, and that's methane leak detection and repair. There is probably literally no one on the planet who says no, we should continue leaking methane. Like, no, this is something we should get good and capture, and it's also, as we found out, profitable. It is profitable for Triple Crown to capture. I'm not going to go so far as to say for the entire industry. We have assets that are specific to us, and that make it a little bit, perhaps a little bit easier and more profitable to go out and find and fix these leaks. We have mostly horizontal wells with higher rates. So when we have a leak, it's bigger, even though by percentage wise it might not be any higher, but the rate is big. So when we fix a leak, we get to capture and sell that methane. So that's one big one that we thought made a ton of sense. This is something we should all embrace. The flaring as well. This is not something that anyone should be proud of. Flaring is designed to basically be a mitigant to catastrophic damage to infrastructure, explosions, and that's why they exist. It is to prevent catastrophic damage, not as a routine practice. And yet that's something Triple Crown, since we were founded, we've been very, very focused. As far back as 2018, when people were still flaring a lot, we wanted to eliminate it almost completely, and we did. Other than for example, last year in the freeze about a year ago, our compressor stations went down. We had to flare a tiny bit. That's just not something we will only do under the most extreme circumstances is flare. And one of the other things we wanted to get very good at is water recycling. We're in a very arid area of the world in the Permian Basin, and we use a lot of water to complete our wells with. And there are rules of what type and what formations of water we can use, but it's just not in our long-term best interests, the long-term best interest of our community, of anything really, to use water resources. So if we produce a lot of water in our operations, let's use that for the next well. So that's another thing we got very good at. And again, that's one of those things that just about anyone in the industry, even the most diehard oil and gas industry cheerleader, can get behind.
So the whole idea of on the environmental side, where energy companies have had to comply with EPA or state regulations, maybe voluntarily with the global standards. That's a number they've done, and LDAR, leak detection repair, they've done all the time. But now, hitting a specific methane intensity number, so what number are you shooting for, and how are you doing on that?
So there's been a lot of moving goalposts and a lot of frustration in the industry. There's a reason people are reacting negatively. A lot of folks think it's a conspiracy theory. Okay, the goalposts keep moving. No, this is just the world, the economy coming together and trying to agree on some standard. And there's always going to be disagreement. So if you look at all the different sources of what should an oil and gas company's methane intensity be, you get a lot of different answers. But the way we're approaching it is, what's the common denominator? What's the most strict of those? If we can get to that point, and best of all, do it profitably, then we know we're in pretty good shape, because regulation is necessarily going to follow those strict recommendations. So when we first started all of this, measuring our methane intensity, actually measuring it instead of having it calculated, we didn't like what we saw. But we put a lot of work into it, made it a huge priority from the top down at our business. And we are at 0.2% or lower on most of the surveys we do, the vast majority of surveys we do. That 0.2%, it's defined as the amount of methane we're leaking divided by our company's total hydrocarbon production. So 0.2% of that is that's what we've achieved. And that seems to be that kind of lowest common denominator from all of these different sources. Paris Climate Accord, different local regulators. Colorado. We were talking about British Columbia as well. We think since we've been able to achieve that, we're going to be in pretty good shape, because regulation is probably going to coalesce somewhere around that number.
And so, is there a benefit to, other than producing it at a profit, right? What are the benefits to doing that? Will people pay you if you could prove that, right? Next, yeah. What was the benefit? Can you sell your gas at a premium? Can you avoid potential fees?
Yeah. Right now, there's a lot of talk in the industry about getting your gas certified, responsibly sourced gas. A few different firms do that, third-party firms, and um, once you get your gas certified, there is a market, the equivalent of credits. You're generating credits, if you achieve a certain threshold. And what's nice about that is if someone who wants to buy those credits sees gas produced with some carbon intensity from our company or whoever's trying to sell those credits, they can pay for whatever they think they're worth. So it's actually pretty powerful. So that's our first iteration here. That market isn't very big. It's not very liquid. It probably needs to evolve. And this is where we get to, at some point, this industry is going to have RSG, actually marketing and isolating the physical molecules that are from come out of the wellhead and go all the way down to the customer. That entire supply chain, being RSG certified, that is going to be powerful. That's going to be where we're a big exporter of natural gas and natural gas liquids and crude oil for that matter. That's where American hydrocarbons are going to garner a premium in the market as an exporter in Europe and in Asia, because they have shown they will pay a premium for energy that has low carbon intensity. So this is actually a great commercial decision. We've got a market. Our market is asking us, our industry, to create a product that has low carbon intensity. There's no reason for us to argue, tell our customers they're wrong. So let's do this, and best of everything. This is profitable. We can do this profitably, even before any sort of nasty carbon tax.
Right, and for that matter, like EU probably is a little more evolved in that, only because they have cap and trade as law, a legal framework there, and it is baked literally into their energy costs, right? So if they don't buy, a lower carbon intensity, energy product like gas, they have to offset that and literally pay, and use up some of their allowable credits and stuff. So they have an economic incentive to buy, low carbon intensity product. On the and then you also mentioned the other thing, that once you first got into it and you were sort of optimizing your operations to hit those numbers, that you saw the economic benefit of that, right? I mean, so there's actually, okay. So
Absolutely.
Even optimizing your operations, you can increase efficiency and therefore profitability. Okay.
Yeah. Oh, definitely. Yeah. And by correct what I said earlier, by nasty carbon tax, I meant something very high with respect to the actual price of the barrel of oil or the MCF of gas.
Right.
And it is going that direction. You're talking about right now, I guess there was $95 a ton for carbon in the cap and trade market in Europe, and that would qualify as pretty high. That's going to raise price of energy quite a bit. And it is a matter of time before it shows up here.
Well, and you mentioned before we got started too that talk about the ES and the G part, the governance part. You literally have bonuses tied to hitting some of these low carbon numbers, right?
Yes, and that's something some of the public companies have done, but it is vitally important. To our when we're a private company, we're going to need an exit at some point, and right now buyers are placing a premium on assets that are. It's hard to quantify right now, but that premium is there on assets or companies whose priority is on at least some of these aspects of ESG, carbon intensity and methane intensity. So that's something we've incorporated as part of our bonus structure. Keeping those below certain thresholds, and really we compare ourselves to our peers, and as long as we're leading our peers, um, that's what it's based on, being a leader in the Permian Basin.
So what we're really saying is not only could it improve, get a premium for, spot price for what you're selling, but it could actually increase the entire market value of a company because you take an asset like provable reserves, you multiply it by the environmental premium or the environmental risk, and that entire value could either go up or go down based on your ability to prove your carbon intensity, your methane intensity.
Exactly. And
So
yes,
yeah,
that's
so that's
exactly
a
it.
much bigger number because it impacts your entire company valuation. Um,
Sure.
so, what would you like to see happen? Like if there was, do standards need to improve? In order for companies like yourself to, be able to prove that you're doing it and, peg yourself against a standard that is more, maybe more objective and achievable and scientific and repeatable and things like that. Like what were you looking for? If you could wave your magic wand and say, "Hey, here's what needs to happen."
Uh, it's the industry is moving really fast. This has a lot of momentum, not just within the E&P industry, but government and the EPA itself has been very amenable to incorporating new technologies. So expediting that process and creating a regulatory framework that doesn't um, that's not overly burdensome, but sets realistic standards for carbon and methane intensity, and that we will have the American produced barrel of oil and Canadian barrel of oil or molecule of natural gas will be in higher demand worldwide. And talk about aligning interest. I mean that's good for every producer in the U.S. So um, the the market is doing a really good job so far of providing that pressure. And this is just investors. This is what the average investor in this country wants, and the average buyer of hydrocarbons in this country wants. So let's give it to them and do this profitably. So it, if anything, it's I, sometimes things just go a little bit slow. You get so many people involved, and you have to come to agreements on, especially when it comes to government regulation. Um, but that's going about as fast as can be reasonably expected. So I think if I had my magic wand, I'd just kind of let's go a little bit faster, grease these skids a little bit more, but like the direction it's going, and to help it get there. Um, the more engaged everyone is, and the more educated everyone is on this, especially those in the oil and gas industry, there is a value proposition here. Let's make our voices heard, and be part of this narrative.
Great. No, I love it. I mean, let's focus, get ahead of it so you can benefit on the premium side, better
Yeah,
price for your product, better valuation for your reserves, and selling a product that everybody can, that is known for that, right? Even in the commodities market where you can sell, hey, I got this premium gas, it's worth more and whatnot, and avoid the
right,
downside of excessive carbon fees and penalties and all the other stuff.
right, right. Exactly,
All right.
exactly.
Any last comments about this ESG subject?
Well, other than it's just it's discussed in public and in private, and it really is a NAPE big conference, oil and gas conference, was here in Houston a couple of weeks ago, um, and it was this was just sitting at the going out to get drinks with friends. I mean, this is one of the main things people talk about, and there are a lot of strong opinions And the best way to navigate this is just to be nuanced, not just like, ESG all the time. That's one end of the spectrum, and oh my God, what we're doing is terrible. No, that's not healthy. And on the other end of the spectrum, like all ESG is dumb. This nuanced middle ground is the magic place. That's where we can make a ton of progress, and we can do this profitably and give our customers what they want. And in the end, like our the hydrocarbon industry, oil and gas, has a terrible reputation, if for no other reason than it's terrible at marketing itself and connecting to its customers, which is everyone in this country. So this is a way to do that, and actually respond to what our customers want. So hopefully that catches on.
Yep. So first of all, I'd let everybody know that your company, Triple Crown, yourself, and a couple of your colleagues are going to be doing a workshop with us called ESG for Energy, actually. And I'm super excited about that because we're calling it the practical ESG, right? It's not going to be, just talk about the academic side of it, but we're going to get down to specifically how to do this step by step. And you're going to reveal a lot of the stuff that you guys are actually doing to kind of hit these goals and kind of seeing where it's going. So anyway, for those who are listening, you can sign up free esgforenergy.com, and I'll have links below this video for how to sign up. And again, Ryan and his team will be there literally laying out how they are implementing their ESG strategy. So it'll be a great case study, as well as other technologies about how to achieve a practical, ESG framework. So,
well said.
All right.
Appreciate it.
All right. Thanks again, Ryan, for being here.
All right. Thank you.